Hi everyone, and welcome to the second in our new webcast series presented to you by Ascend from Cirium. I'm George Dimitroff, I'm the head of Valuations, and I'm going to continue on the theme that was started a few weeks ago by Rob Morris with our first recorded webcast. The idea behind these webcasts is that rather than having them live as we had before, they're now recorded. You can listen to them at any time that suits you, and then you can ask us questions afterwards by email, and then we can always cover those in a new topic. So thanks for joining on this one. I just wanted to give you a quick update about Cirium. For those of you for whom this is the first ever webcast, Cirium is our new brand. It's the same services and products that you're familiar with from previously Flight Global and also Flight Ascend. Well, the Ascend brand remains. Cirium basically enables you to fund your fleets, to build and maintain aircraft, to transport passengers, and also to improve traveler services. So perhaps most people that were familiar with one of our brands, such as Ascend or Innovator or FlightStats or Dio, knew the specialities of that brand, but they don't really know that Cirium actually offers a lot of other services outside of just those brands. And so we brought everything together under a completely new name and took it to the next level. The Ascend brand, of course, remains associated with all of our valuations and value-related products and services. And of course, the Ascend team remains exactly as you know us under Pro Services. So in today's podcast, I wanted to touch a little bit on some hot topics. First of all, I just wanted to give you an update of the latest lease rate movements that have been happening between January and now. I think the last time we did this was on a live webcast at the beginning of February, so there's been some movement since then. I also am going to touch on the 737 MAX grounding. It's a sensitive subject, but I believe we do need to talk about it. I'm not necessarily going to focus on the accident. I'm not going to focus on any technical issues so much, but I'm going to focus on our approach of how we look at values and what we would do in such a situation. And then finally, I'm going to just touch very quickly on the wide-body market and what we expect for this year, any trends that we might be seeing. So let's begin with some of the value and lease rate changes. The biggest ones, which took effect at the end of March, are some considerable reductions to lease rates for the A320neo family and also the MAX 8 family. Now, some people will jump and say, hold on a second, I thought the problem was only the MAX. Hold your horses. So there are several things at play here. First of all, I need to make it clear that all of our lease rate changes are driven by market information and transactions prior to the grounding. They are reflective of supply and demand that was already in place just prior to the grounding of the aircraft. And it was market trends that were already happening. Now, I guess the next question that arises is, I thought that there was a lot of lessor availability only for the MAX. I thought the Neo was okay. Yes, that is true, but we've had to make some calibration. So let's just go into a little bit more detail. Basically, the reductions to the A320neo range from around 3 to 5%. We had both aircraft types at the beginning of this year, and Q4 of 2018, January 2019, we were at about 355,000 in monthly rent for both a Neo and a MAX 8. That's an A320neo, by the way. And then the market seemed to demonstrate pretty rapidly as the first quarter evolved that there are a lot of lessor positions for MAX 8s, which are still not placed in 2019 and in 2020. Rob did touch upon this in his review of the ISTAT conference in the previous webcast. And so we actually gathered a lot of data points, and it became quite evident that max lease rates were down significantly. As you can see here in this table, they're actually down around 12 to 13%. Obviously, we don't have a market lease rate for the MAX 10 yet because it's not built and it's not flying. So some reduction for both types, but more so for the MAX. And what is driving these? Well, basically, as I said before, the A320 family is not experiencing the same issues as the 737 MAX when it comes to the leasing community. If you look at the speculative lessor order backlog for this year and next year on the A320neo, it's largely placed. However, it was placed at a price. Everything gets placed with an airline at a certain level. And so we looked at all those placements, well, not every single one, but we looked at a very healthy sample of data points for lease placements on A320neos, and we had to recalibrate our lease rates. So the premium that the A320 has now for a neo over a CO with sharklets is just around $5,000, which is really reflective of the fact that perhaps we're in a slightly lower fuel price environment, and airlines are not as concerned about fuel, and they're not willing to pay too much of a premium for the new technology. They're also taking on some risk with engine reliability, and even though Pratt & Whitney and CFM have made some improvements going into this year, and the engine issues are slowly being resolved one by one, there is still a comfort that comes with operating a more reliable CO aircraft. So that explains the reductions for the A320neo. When it comes to the MAX family, and I'm focusing on the MAX 8, the reason is all those unplaced slots. Now, this was already an issue even prior to the grounding. Okay, the estimates vary. Our fleet's database only captures some placements of aircraft that are speculatively ordered before they're delivered. For others, we're only going to know that they're placed when it's time for delivery, but not every lessor tells us in advance. So if you start to look at the number of aircraft that need placement, the estimates are around 50 or so aircraft for the remainder of this year, and perhaps 100 or so for next year. So they range from 1 to 200 aircraft over the next 2 years. Let's call it 150 on average. Those are a lot of delivery slots that need placement, and that's why we had to reduce our lease rate on the new MAX 8 down to around $310,000. The MAX 9 also came down accordingly by a similar percentage, because let's face it, if demand for the MAX 9 was much higher than it is for the MAX 8, all the lessors would be switching their orders to MAX 9s and placing them. But that's not exactly the case. And so we could see that even prior to the grounding, the lease rate environment was weak. Now, our lease rates do not take into account the grounding, because all of our values and lease rate opinions are based and assume that the aircraft is airworthy and is compliant with all airworthiness directives and service bulletins. And I'll touch on that a little bit later when we talk about the MAX. So that's the situation. We now actually have MAX 8 lease rates below the 737-800, and that is just the reality. So in other lease rate movements, we have seen some reductions to the larger Embraer E-Jet family, especially the 190, 195. The reasons for those are twofold. For the E1, which are the previous generation, there is a growing supply. A good number of aircraft have been retired, and others are coming off their leases at anything from age 8 to age 10. And as those aircraft come off lease, they are being placed, which is the good news. The fleet is shifting. That's a sign of liquidity. Embraer is very actively involved in the process. They've actually built a center in Georgia that will be helping E-Jets transition to new operators, and their goal is to reduce transition costs by up to 40%, which is good news if you're a lessor or an owner of an E-Jet, because if they can reduce those transition costs, especially for the cabin and the airframe, that will make it a lot easier to place aircraft. So even though there's a reduction in lease rates, there is a positive in that the aircraft are not sitting parked. They are transitioning, they are moving. But the lease rates are down quite considerably. For the 190E1, we're down by 16%. And for the 195E1, we're down by 14%. It seems like the majority of used leases happen in approximately the $130,000 to $160,000 a month range, and age is becoming a little bit less important. So it's those younger vintages actually that are suffering more because they don't really get much of a premium compared to the older vintages. The airline just sees it as a used aircraft, and if there's a few years difference in the vintage, doesn't matter as much to the operator. Also, when it comes to the E2 models, there was quite a large backlog with a few lessors, AerCap perhaps being the biggest one, which they inherited from an ILFC order. Fortunately, now a good portion of that backlog is placed. Certainly most of AerCap's one is placed. Other lessors, such as Air Castle, I believe, still have some aircraft available that they're still looking to place with airlines. But it was quite a struggle for the lessors to place those E2s, and they had to really drop the lease rates. In fact, we see very little premium for an E2 over an E1 equivalent, especially on the 190, which is the same size. The 195 being a slightly bigger size for the E2, they have been able, in some cases, to achieve a bit of a premium, certainly, at least in our lease rate opinion. The good news is now that with the majority of that fleet placed, we believe that lease rates are going to stabilize. And just a few other value changes that have happened in the first quarter. Nothing too exciting, certainly nothing of major concern to the majority of aircraft financiers and investors. There are some mixed dynamics in the 737 Classic freighter market, which I'll touch on separately in the next slide. We also revisited ATR 42-600 values. It's a very niche aircraft type, and we think that the slightly high supply of ATR 72s doesn't necessarily mean that the values of the 42 are going to be impacted as we did in December, January. So we actually made some slight improvements to the 42 because there aren't many out there, and if certain airlines need an aircraft with specific performance requirements for specific, maybe short field performance on short runways, then that is the only aircraft that they can get. And so we're seeing the gap between a 42 and a 72 close even further. We reviewed Dash 8s 1-300. And despite the high storage levels, the aircraft remains in demand. It's got some unique performance attributes. As long as it's not near its 80,000 cycle life limit, values are stable. And then it's like trying to catch a falling knife, but A345 and 600 market values were reduced by about 7 to 10%. Again, mainly because part out values are decreasing. Some airframe parts are common with the A330, but the landing is different, the APU is different. So the airframe part out values continue to go down. The engine values are already quite low, and we have to make some further reductions there. There really is no demand for the aircraft. Even ACMI operators that have a few A340s are now looking at getting used A330s instead, and I'll touch upon that in the widebody section coming up. So what's happening in the freighter market? Well, as you may know from the macroeconomic picture, air cargo growth is slowing globally this year. It's definitely a lot slower than it was a year ago. And China in particular seems to have hit the brakes on growth. We believe this is temporary, but China was a big player in demand for narrow body freight aircraft, namely the 737 Classics, because of its large growth in e-commerce. So when China hits the brakes on growth and when the global growth is also slowing down, that means that a market which was previously red hot has now cooled off a little bit. Some 737 Classic freighters have been returned off lease, especially the 300s. And others are being advertised as available for sale or lease. Now, having said that, it's interesting that the max grounding, which nobody knows how long it's going to last, but potentially that could mean that some newer 737-800s, which were previously scheduled for conversion, may not be converted as soon as expected. They might defer their conversion slot because the airlines will still need them as passenger aircraft. So if that tightens the supply of 737-800s for a period of time, that could actually boost demand for the 737-400 classic freighter again. So a slowing cargo growth, but then this other issue of delaying perhaps the feedstock of 800s for a little bit could benefit the 400. We actually made increases to values at the older end. We're seeing that the market really doesn't differentiate between vintage that much. I mean, in a few countries there are active age restrictions, and so they have limitations on the oldest aircraft that they can import. But the majority of the market where these freighters operate doesn't seem to be affected by these age restrictions. So we increased our values for the older freighters, especially on the 400. Whereas on the 300s, we had to reduce the younger ones. So both value curves have flattened out, but the gap between the two has grown a little bit. The 300 values really benefited previously when you just couldn't get a 400. Then people said, okay, well, we'll get a 300. But now as availability of 300 starts to show up, there's some demand for 400s. And there's still conversions ongoing, by the way, for the Classic. 12 more 400 conversions are in the pipeline, but only 2 -300s. So a little bit of that on freight. So let's talk quickly about the max grounding. And mainly what I want to focus on here is what approach is Ascend taking when it comes to values? How are we looking at the situation? First of all, is this the first time this has happened? No. We had something like this in 1979 when the DC-10 was grounded. The DC-10 had some pretty gruesome accidents in its time. The grounding in 1979 lasted 5 weeks, and the market kind of recovered. I mean, they kept producing it for almost another 10 years until the end of the 80s. But it did have some impact on subsequent new sales for the type. So even though the market returned to it and took deliveries, confidence was a little bit shaken. However, that was a very different time of different aircraft, different situation. Another one we had was in the helicopter market, which I don't delve into too much, but the H225 helicopter was grounded from 2012 to 2016 in some situations, some cases even beyond 2016. That grounded lasted 4 years or more. There was a brief return to service in the middle between around 2014-15, and then there was another accident and everything was grounded again. In that case, there was a massive impact on market perception, and the helicopter still hasn't recovered to this day. People are repurposing those helicopters for other uses like military support, where basically safety is not as much of a concern. If you're flying in a war zone, you could be shot down by missiles. You're not really worried about the gearbox failing. So it's a bit of a unique situation there. And then more recently, we had the Boeing 787 in 2013. That was grounded for about 3 months, and the aircraft perception was restored quickly. Boeing came up with a fix. Not all market observers may have thought that the fix was ideal, but it worked, and the aircraft continued to deliver. It basically made a full recovery. There was no impact to values. The only thing I want to point out is that for the 787 grounding, unlike the other 2 examples that we have in the past, there were no fatal accidents with the 787. There were a few fires that occurred on the ground, and nobody was hurt. So what do we do? How do we look at the situation? Well, let's be realistic. We are unlikely to see any real trades during the period of grounding, right? Because everybody who already owns a MAX is not going to try and sell one right now. That would be like shooting yourself in the foot. However, there are some things that we would look at to determine what may impact the value. So the first thing is the duration of the grounding. How long will it last? And once we know what the fixes are, what the solutions are, once we know what remedial action Boeing will be taking, how long will it take to retrofit the fleet and to return the fleet to service? And that's just from the technical aspect. But in addition to that, you also have the speed of recertification. Remember that before whatever the FAA did, everybody mirrored. After what's happened, we might see that maybe EASA or China decide to play hardball and decide to do their own certification process, which could take longer. So even once Boeing has a fix in place, the recertification by the different authorities may not necessarily happen simultaneously, which could result in the fleet returning to service gradually rather than altogether. So that's another variable that we're monitoring closely. And by the way, we have weekly discussions about this with the Value Review Board. The third one is the severity of the findings. Can the design flaws be fully fixed in a way that the airlines can accept confidently? Or does it look like a partial solution? Because I think the severity of the findings and the quality of the solution to those findings will determine both airline confidence and public perception. And I think that leads us to the next point is we are in touch with the market. We talk to lessors, airlines, banks, financiers, MROs, and manufacturers themselves. We talk to all different players of the market. And so we're constantly gauging the market's opinion or the market's perception of the situation. So just gave an example, like the 787, the reputation was only briefly scratched, if you like, temporarily, or will the reputation of the aircraft be permanently impaired like the H225? For us to actually move values, we'd need to see meaningful changes to these variables. And then finally, what's the impact to the order book? Have there been any cancellations? Will the order book shrink or not? When will once it's back in service and the fixes are in place, how will the order book proceed from there? If there are cancellations, if the order book shrinks, to what extent does it shrink? So far, we've seen airlines threaten to cancel, but we haven't actually seen a firm cancellation as far as I'm aware. So in summary, just remember, first of all the values we provide currently online assume that the aircraft is airworthy and all service bulletins and airworthiness directives are complied with. We carry out a weekly assessment with the Value Review Board. We're monitoring the situation. We're looking out to see if any cancellations start to happen. And also, could there be any distress sales during the grounding period due to airline failure? I won't mention any names, but let's say that an airline of weaker credit that has a fleet of Maxes, let's say that they cease operations and while the aircraft is still grounding, what happens to that fleet then? Will it remain grounded with the lessors? Will there be any distress sales if the airline owns the aircraft? And if so, what will happen to those? And finally, we're constantly considering third-party value opinions, bids and purchase offers, of which there are none right now. But as the situation is remedied, as the fleet starts to return to service, there probably will be. There will be some resumption of trading activity, and we'll be able to get a good feel for the pulse. We're certainly not making any changes to the long-term base value or residual value outlook for the type because it's too premature to do that right now. The base value is a long-term forecast. It's a view of the underlying economic value of the asset. And that's a decision that we cannot make until there's a lot more clarity on what's going on. So in the worst case scenario, let's say that things just continue to get worse. Let's say that the grounding is quite extended. What are we looking for? How do we actually decide on what to do to the value? How do we decide on how much to change it by? Well, ideally, we'd need comparable sales or some kind of trading prices. That's ideal, but likelihood is there probably won't be much, if any. Secondly, in the absence of trades, we need to see clear evidence that the market perception has experienced long-term damage, and what kind of damage has that been. If we see that that's clear and evident, then we may have to move to reduce values. At the moment, it's not evident. If only part of the fleet returns to service, let's say that you get FAA certification, maybe EASA, but not China. This is all hypothetical. What percentage of the fleet has returned to service? How does that impact the liquidity of the aircraft? What does that mean for potential resellability of the used aircraft? And finally, if the grounding situation is prolonged, we may actually decide to simply stop providing values, as we did for the H225 helicopter, because one of the key conditions of our values being provided, which is airworthiness, is not present. So if you don't check that airworthiness box, then perhaps we simply might have to switch off our values for a period of time. But again, for the time being, the grounding has lasted just over, I believe, 5 to 6 weeks. So it's too soon to make any of these decisions. So the difficult stuff aside, let's talk a little bit about what's happening in the twin aisle market before we wind up, because I don't want to take too much of your time. The latest market dynamics for twin aisles. Basically, last year, there were quite a few issues with the Rolls-Royce Trent 1000 engine on the 787. A lot of them had to go through shop. It resulted in a lot of temporary groundings of 787 aircraft while their engines were going through shop. And that created a boost in demand for A330s and to a lesser extent the 777-200ER fleet. It kept them flying through a mix of both dry leases, wet leases, and ACMI. And in some cases, especially with the A330s, in some cases, those aircraft that were taken in as temporary relief for the 787 were actually kept by the airline for growth because they discovered that they can put them to good use in new markets. So that was a positive last year, especially throughout the busy summer travel period, the Northern Hemisphere summer anyway. It created quite a bit of demand. And as that started, as we moved into the new year now, a lot of the engines are being fixed. Rolls-Royce has now certainly gotten through the worst of the overhauls. They're getting back on track. And so if you look at additional A330s that are now coming to the market, and if you look at availability on Airfax at the end of Q1, availability of A330s was up significantly. Availability of the older 777 models is also growing. Speaking to lessors who are active in the market, currently trying to place aircraft, the feedback we get is that basically a lot of airlines are not looking for additional capacity, not looking for additional lift. This could be because airlines are being a little bit more cautious about capacity expansion. We reviewed our A330 values very carefully in the value review board that we had 2 weeks ago, and we decided that based on the information we have so far, there's no justification for any changes to values. So we kept A330 values and lease rates stable. However, we are monitoring them because as we go forward throughout the year, both in the case of the A330 and in the case of the 777-200ER, we do expect some increases in availability. And finally, when it comes to the new twin aisles, especially those that have unplaced lessor backlog, like the 787 mostly, we are seeing reduced lease rate factors. That's driven by competition between lessors. Now, I know there aren't as many lessors with spec wide-body backlog as there are with spec narrow-body backlog, but the competition is there nonetheless. Lease rate factors are under pressure across the board, across all aircraft types that lessors have. And so these lower lease rate factors have translated to perhaps increasing number of data points on 787s that are trying to show perhaps lower lease rates for new placements. Now, we haven't moved our lease rate opinions yet because we're seeking more evidence, but we are noticing the trend. So the lease rates for new 787s and perhaps A350s, although again, there's no evidence yet, but they are on watch. So with that said, I want to thank you for listening. This concludes today's webcast. You have my email address if you have any value-related questions. If you have any subscription-related questions, you can email marketing@cirium.com. They will be able to get you links to access the previous webcast that Rob did a few weeks ago, and also get you subscribed to email so that you get notifications of future webcasts as they happen. So thanks again for listening, and stay tuned for the next webcast. There's no scheduled date for it, but we will be in touch with you by email. Thank you for listening again.